Welcome to the deep dive. We're jumping straight into the data stack today. We're looking at that massive digital asset crash, October 10th, 2025, just a brutal day. Over, $560 billion wiped out globally? In 24 hours. But here's the really strange part, the paradox we need to figure out. This, historic crash happened on the exact same day Wall Street basically confirmed this asset class is here to stay, structurally integrated. How does that even happen? The day it's confirmed permanent is the day it has its biggest crash. That disconnect, that's what we need to get into.
That's absolutely right. So our mission here for you is really to unpack what drove this, unprecedented market dislocation. We have to figure out what mattered more in that moment. Was it the short-term geopolitical shock, the thing that started the panic? Or was it the kind of foundational, long-term institutional adoption that, believe it or not, actually picked up speed underneath all that chaos?
Okay, so let's start with the trigger. The sources seem, pretty clear on the immediate cause, pure geopolitics, right? Foreign President Trump's announcement. 100% tariff.
On critical goods from China? Yeah.
And he specifically mentioned Beijing's new export controls, the rare earth minerals.
Right. And that wasn't just, political noise. That hits global supply chains hard, instantly.
And the digital asset market just reacted.
Immediately.
Instantly. But what's key here, and really fascinating, is that this wasn't a crypto-native failure. It wasn't like DeFi blew up or something. This was a forced deleveraging, driven purely by that macro shock. We saw over $19 billion, that's billion with a B, in leveraged positions just liquidated. Poof, in 24 hours.
19 billion.
Affecting maybe 1.6 million investors, the estimates say. It's the largest liquidation event ever.
That number, 19 billion. It's hard to even grasp.
It really is. And it just shows you how fragile leverage can be when, a big external shock hits the system.
Okay, but for people maybe not deep in derivatives, how does a political announcement like a tariff suddenly cause that kind of massive mechanical sell-off? It's actually pretty simple mechanics, really. When that news broke, anyone holding leverage longs basically bets the market would keep going up. Suddenly, the value of their collateral just plummeted. And the automated systems, the liquidation protocols designed to protect the lenders, they just kicked in, sold those positions immediately at any price. Just get out. And that forces prices down even faster, which triggers more liquidations. It's a cascade.
A downward spiral.
Exactly. You saw Bitcoin, which was cruising above $126,000.
Yeah, strong numbers.
Suddenly plunged. It briefly touched down near $102,000. That just flips the switch, Market sentiment went from extreme greed straight into, acute fear, almost overnight. But, okay, here's the counter-narrative. While all that blood was on the retail screens and the liquidation bots were going crazy, the institutional decision-making, that's colder, longer term. It didn't just hold steady. Yeah. It actually accelerated.
Right. That's the huge news that got completely buried in the panic. While Bitcoin was nosediving, Morgan Stanley announced they're opening crypto access to all their wealth management clients.
All of them.
And explicitly including retirement plans. That's the kicker.
That's massive. You're talking about unlocking just vast pools of tax-advantaged capital.
It signals more than just interest. It's okay, we're building this in permanently, strategically.
And it's not just the users or the advisors. If you connect the dots, look at the banks, the big plumbing of the financial system. You've got major U.S. banks, both Goldman, Citi, now jointly exploring, as they put it.
Exploring? Sounds tentative.
Well, yes, but exploring what? A shared stablecoin, specifically for settlement between them.
Hold on, though. A shared stablecoin between major banks, that doesn't exactly scream decentralization, does it? Isn't that just TradFi building their own, highly centralized permission digital cash, walling off their garden? How does that help the broader crypto space?
That's a really important question. It definitely raises flags about, the direction of this integration. Is it true adoption or co-option? But if you look at it structurally, just for a second, you've got Morgan Stanley bringing in the traditional users, the retirement funds. You've got the big banks working on the back-end infrastructure, even if it's permission stablecoins for now. And then sovereign entities are maybe providing the final layer of validation.
How so?
Well, another piece that dropped the same day. A new Deutsche Bank report. And it predicted central banks will likely start adding Bitcoin to their reserves alongside gold, maybe by 2030.
Wow.
Framing Bitcoin as potentially a sovereign-grade asset. So you see movement on all fronts, even amidst the chaos. User access infrastructure, sovereign view.
Okay, but wait. We just established the entire market is basically hostage to a U.S.-China trade war now.
Right.
That was the trigger. So how can we seriously talk about a generational buying opportunity if, like, the whole thing could be derailed by the next tweet or tariff announcement?
And that is the profound dislocation we talked about at the start. That's the paradox. This
Yep.
event, this crash, it absolutely flushed out a ton of speculative leverage. Forced selling, panic. But arguably, it solidified the underlying fundamentals. The institutional pieces clicked more firmly into place.
So it created this huge divide.
A really clear divide, yeah, between the traders who got caught, maybe forced to sell, and the long-term investors, often institutions, who see this external shock as creating a discount. They look past the short-term price action, which completely ignored the strengthening long-term institutional story that day.
So bottom line, the driving risk is confirmed. Geopolitics. That U.S.-China tension. It's the biggest, most potent short-term price mover right now for digital assets, period.
It absolutely seems to be. Which brings up one last sort of provocative thought for you, for the listener to maybe chew on. If we now accept that this market is this vulnerable to nation-state conflicts, to trade sanctions, potential financial censorship down the line, does the fact that privacy coins like Zcash, for example, which actually saw double-digit gains during that crash, does that signal something important? Is there maybe a growing segment of the market that's actively preparing for or hedging against a future maybe defined by more conflict and a potential flight to financial anonymity, something to consider?